Steve Clone here with Clone of Villaplana. I'm here today with Susan Belize from Family First. We're going to, Family First Funding, excuse me. We're going to kind of debunk the whole closing costs for buyers. One of the things I get frequently is my lender told me to speak to you about my closing costs. So, Susan, should that even happen?
No, not really. The loan officer should really control the monies to the table because that's what's coming from the deal, right? You can go over maybe like what the title is and what your fees are, right? Because you're ordering the title, but mostly it's better that the loan officer takes control of that and really says, hey, listen, this is how much money you're going to need in total to purchase the house that you're in contract for. So I think that really they should be calling you about what your fees are and when your fees are paid. But the rest of the fees should be really kind of talk to with the loan officer.
Right, and part of your estimate is going to give an overestimate of title, so they have all that. So pretty much the only thing missing from the equation would be my fee.
Right.
But you're going to go over all the other fees. Now, talk to me. So a client gets a loan estimate.
Yes.
What is that consist of? What questions do clients have? Let's explain to the clients what they're looking at.
Okay, so first of all, you're going to get a loan estimate 3 times during the process. The first time is what we call the initial disclosures, and that's kind of like where your loan officer is looking at your purchase price, what your rate is, if there's a cost for that rate, where the property is, what the average taxes are in that area. And what we're going to do is we're going to overestimate those fees in the beginning in order to make sure that you have enough money throughout the process. And that's the initial disclosure. So you sign those, and then as we get really deeper into the file, like we're going to get a title bill from you guys, we're going to get what the taxes are that are due. All the invoices start to come in through the middle. Usually in the middle of the process is when we'll start to lock the loan, and your loan officer will talk to you about locking the loan, but at that time is when we can really tighten up those fees. So in the beginning, it's an overestimate. In the middle, it's closer. And then at the end, when you get to your closing table, like 3 days before your closing, there's adjustments that come in from the other side. Maybe they paid taxes. The seller may have paid taxes where you have to reimburse them. So in the beginning, it's an overestimate, but we don't ever really think that that's what you're going to pay. It should be approximately 5 or 6% of your purchase price. Like that's kind of a broad statement, right? But it would cover you from start to finish, meaning everything that's involved with fees, inspections, appraisals, insurance, the title report that you mentioned. It includes your attorney's fees. It includes bank attorney fees. It includes the bank fees. It pretty much is a very broad way of saying 5 or 6% should cover you from start to finish. And I think that that's the best way to do it up front. But again, as the invoices come in, we start to narrow those down and you'll see those fees start to come down. Now, not every bank does it that way and not every loan officer does it that way, but that is the way that I do it because I think it's smarter to make sure that you have enough money in the beginning of the process to cover everything that you need because things can pop up, right? Things can happen. Maybe taxes are higher than we thought, or maybe school taxes come in. We need to make sure that in the beginning that we are not setting you up for a shortage right before closing. So fees are really important, and it's the biggest question I think that everybody gives us throughout the process. How much do I have to bring? How much do I have to bring, right? Well, what you have to bring is what Susan said in the beginning, and then right 3 days before closing, Steven's office and his great team is going to kind of call you and say, this is what you need to bring to closing and tell you how to divvy that money out. But I wanted to talk today also about what fees are on a loan estimate and a closing disclosure. So, right, we know that there's bank fees. There's an underwriting fee and a processing fee. There's a flood cert fee. Now, you might not be in a flood zone, but we have to run a cert that tells us whether or not they're in a flood zone. That's $15, right?
Nothing big.
It's nothing big. There's a credit report fee depending on how many borrowers are on the loan. That's going to determine how much the credit report fee is. $50 for one, $100 for 2 people, and then it kind of, goes up from there depending on how many people are on there. The other fees are something like an appraisal, which you would pay really outside of closing. That's one of those upfront fees that you'll pay, but we include it in our estimate in the beginning because if for some reason you can't pay it, we'll put it on the loan closing. So you would pay like $495 for a single family house. You would also pay for an inspection before we even got to disclosures, right? So there's outside fees, but in that 5 or 6% that I'm talking about, it covers that from start to finish. So it's never like there's a hidden fee, right? Fees are talked about pretty much every day, all day long throughout the loan process. You're going to get the questions and you're going to say, hey, go to my video, right? And I'm going to say, I can tell you what they are today. I can tell you what they are in the middle, but I don't know what they will be in the end until we get everything in. So,
to check 1 second here.
Yes.
So you mentioned, so the inspection fee, which is not part of anything in the bank costs, that is, you're just saying that they're going to pay that before, or they should do an inspection, so they should pay that before they go into contract and
Right.
actually apply. The only fee, and correct me if I'm wrong, but the only fee that you're ever going to take, and it's really not you taking it, is the appraisal fee, correct?
Correct. So, yes, you are correct, because the inspection fee would be paid out prior to. And then when we get into contract, I am going to ask for an appraisal fee before we submit the loan to underwriting, because we have to order the appraisal. That's the only fee that they really pay for outside of the closing that pertains to me, the lender.
And I get this a lot too, and we'll go back to fees in a second, because it's really about fees, but this is just
Sure.
something good and I think it's going to help our audience out here. And not that they should do this, but what happens if they pay an appraisal fee, but then decide, I want to go with a different lender? Is there a danger to them other than maybe going with the wrong person or taking too long, which honestly speak to your attorney before you switch lenders, but because you have a responsibility to make sure you've been diligent in applying. But is there an issue? Are they stuck with any one person once they've paid that appraisal fee?
No. So, I don't know what answer you were looking for there, but
That's
the
it.
answer is no.
No, that's the answer.
The answer is no. The only time, though, if you're switching lenders, that the appraisal can be switched to the new lender is when you're doing an FHA loan. When you're doing a conventional loan, most lenders will not let those appraisals be interchangeable. So you can assign the FHA case number and the appraisal to the new lender, but on a conventional loan, those higher credit scores, those lower debt to income ratios, those will not be interchangeable. So if you're having a problem with your lender and you want to switch, there's got to be a reason. I would talk to your lender about it before just switching, because you could be subject to a new appraisal fee with the new lender.
And we'll go back to cost in a minute, but I also get clients that check in with multiple lenders and they start saying, well, this lender's giving me this rate, this lender's giving me that rate, but they haven't gone through the whole process.
Right.
Explain that to me.
Okay, so you can call up Chase today and just say, I'm looking to buy a house. What's your rate today? Most likely they're going to say 2.75 or 2.5 or 3 1/8, whatever the case may be on that particular day. But what you don't know, and what the loan officer doesn't know, is what your credit score is, what your income is, what your debts are, my goodness, there's so many things that go into really what can be charged. They can tell you 2.5, but when you actually start the process, that could mean that they're charging you points. Origination points will show up on your loan estimate under loan origination, and it's a percentage. So if it was a $100,000 loan and it was 1%, that would be $1,000 to buy down that rate to the one that they're quoting you. So you have to be careful. When I say to you that there are no hidden fees, it's because you and I are speaking about those things up front. If you want to buy down the rate, that is the only time that you would be charged points with our bank. But a lot of banks will give you the lowest quoted rate, and then all of a sudden you get a loan estimate, and there's 3 points on there, which is not even allowed. But they do it, because I just have a guy, just for a quick story, refinance, where he said, this bank gave me 1.99. I said, all right, send me over the loan estimate. Let me take a look at it. It was 1.99 for a 20-year mortgage, but it also was charging 3.5 points. In this market where rates are so low, if you're going to pay points, it has to make sense. Whatever you're paying as a fee for an origination to buy down that rate so you get the lowest rate possible, you need to be able to recoup that within the first 3 years. Otherwise, it doesn't make sense to do it. Because the amount of the difference between the rate that maybe you should be getting versus buying down that rate to that 1.99, I mean, could be minimal. Could be $50 a month. So why would you do that? Why would you pay something like $15,000 to save $50 a month? Your loan officer should be explaining these things to you, and they should absolutely be going over what your options are and let you be the judge of how you want to control that. But the option is available to buy down your rate. There are points involved for that, but most of the time, if I were to show you the payment of what you do qualify versus what you're looking for, it's very minimal, and you probably don't want to pay the points.
So that's interesting. And before you had said that in New York, at least, because I know that the other states you work in, it's a little bit different, but in New York, the closing costs can be pretty much 5 to 6%. But you just said that your bank is not charging those fees. So as a prospective buyer, I'm gonna say, well, why is it 5?
Why is it so high, right? So in the state of New York, there's what we call mortgage tax, right? As a buyer, you pay some mortgage tax. As a seller, you pay transfer tax. So the state always wants to get what they want, right? So there's a fee for that, and the percentage.
I know it varies, but it
does.
It's more than 1%, depending where it can be up as high as 1.8% for residential. So
it can get crazy.
dependent.
It can get crazy. So people always ask me, why are the fees so high? And I always tell them, listen, my bank only charges $18.85. What does that cover? That covers underwriting and processing, right? Because your underwriter has to approve your loan. The processor has to gather all the documents to make sure you can get approved for that loan. Then the flood cert that I talked about, which is $15, and the credit report fee. Those are the only bank fees. We do have special programs out there for, people who we consider heroes or champions, the essential workers. We really feel that we have to give back to the community that's providing for the community. So there are times that we will waive those fees, so don't be afraid to ask about that. If you feel like you should be having those fees waived, or maybe we're short a little bit of money to close, my bank takes that into consideration, and our goal is to always get you into the house. So if you are a little short, we do have the ability to waive those fees. So don't worry about it. Just ask me. If it can be done, we will do it.
So 5 to 6%, but your fees are less than $2,000.
They're less than
So
$2,000.
the rest of them are pretty much standard fees that any buyer would have to pay.
So where the big fees come in, right? I mean, title covers a lot, right? You're talking about searches and bankruptcy searches and mortgage tax. I mean, taxes, real estate taxes, right? So let's just say that the seller in January paid his first quarter taxes for his real estate. And then in February, you're closing. You have to reimburse him for the first month, right? Isn't that how that works, right? So if you close February 15th, but he's paid the full quarter, you have to reimburse him from the 15th to the end of the month because he doesn't occupy that house. So there's a reimbursement of those. But then there's also escrows that we pick up. So when your mortgage payment includes your taxes and insurance, we have to start what we call an escrow account. This will allow us to pay the taxes on your behalf even before your mortgage is due. Because if you closed in February, your first payment's not going to be due until April. So who pays March? We have to pick those up at the closing. Then we also have to make sure we have enough money in there because your mortgage payment's not going to cover your taxes, right? We have to build that up. So we take another additional 3 months of taxes and insurance in order to build that escrow so you're never falling behind. Every time you make a mortgage payment, we put money into the escrow account, and then when the taxes and insurance come due, we pay it on your behalf because it's all incorporated into your mortgage payment. So those are fees that people never think about, right? Those are fees that nobody even thinks about. Oh, I didn't know you were going to collect for 3 months of taxes. Well, we have to in order to make sure that you're covered and you're never falling behind. Title, again, is that is the one where you're going to see the most of the fees, right? The bank's fees look like like this on there. And we will upload a copy of a loan estimate so you guys can see what that looks like, right? We're going to try and get that on your website, just so you can kind of see what it looks like. And then there's recording fees, right? And there's, what's the other one? Recording, the title.
Home insurance.
Homeowner's insurance. So some banks will make you pay a year's worth of homeowner's insurance up front. My bank does it a little different. You can pay for it at closing. So you're going to pay for it on the closing statement, but we're also going to take an additional 3 months of that in order to start that escrow account. So on your homeowner's insurance, you really should be like a year and 3 months ahead.
You know, I get that question a lot from my clients. They really don't understand. They say, wait, my bank's escrowing first, so why am I paying homeowner's insurance?
Right.
You actually pay for the whole year in advance, and when the bill is due next time, the bank pays it.
Correct. So we're putting out the money on your behalf, and the only way that we can do that is to make sure that we have collected enough so that at the end of the year you're not getting a mortgage statement from us saying you have an escrow shortage, right? You never want to have to like pay at the end of the year for any money that we didn't pay out on the taxes, or we were short, we fronted the money on your behalf and now we have to collect it from you. So the whole idea of the fees is to make sure that we are protecting you throughout the entire loan process and the next 30 years. It's not just, hey, we're collecting our fees, and then, oh, you paid 6%, but next year we'll revisit that, right? It's not like that. The fees cover everything from start to finish, and they take you through your first year with no issues. I mean, if taxes go up, you know, that's going to raise some questions down the line, but as far as the closing is concerned, well, the way we work together, right? We are always like zeroing out, we're always matching, we're always making sure. I'm going over those fees with them at least 3 times during the process, and then your office is going over them twice, once right before closing and once at closing. So, I mean, we're really reviewing fees 5 times during the process. But the question is always, how much money do I need? How much money do I need, right? And although we want to be able to tell you exact numbers up front, it's just impossible for us to do so. So the best way to do it is to have an open dialogue, or watch this video, but have an open dialogue with your loan officer to make sure that you're really understanding where the money is going. Again, you'll get a loan estimate in the beginning, and it'll say what it says, but most likely you'll be $2,000 to $3,000 less than that by the time we're closing.
Right, and math is math. So like Susan said, at the closing, you're getting a title bill. You're going to see exactly what title picked up and why your bill is that much. You're going to get a closing statement from your attorney, which is going to break down, like Susan gave an example of adjustments. If you're, you know, depending where you're buying, taxes are picked up differently. You know, Yonkers, it's 3 times a year. New York City, it's 4 times a year. Upstate, it's a whole different world. But I have a video about that. Watch my website.
Right.
So, you know, you're going to know exactly what you're coming out and why. And don't fear. You know, trust your professionals. Once you get the closing statement, we're going to show you everything and where it is. We're not hiding fees. We're not charging everything. It's in black and white. You need a closing statement from me, title company bill, and a closing disclosure from the bank, and everything's going to itemize. And if it didn't, we wouldn't be able to do our job.
Every time a fee changes on the loan, every time, whether it be for $5, $10, $1,000, whatever it is, you are signing what we call a change of circumstance updated loan estimate. You'll get a change of circumstance if we lock in a rate that's lower than what I originally disclosed you for, if the loan amount goes up, if one of the fees have changed. Maybe my overestimation of the fees in the beginning was too high, and there's a certain percentage that I have to redisclose to you because they're coming down so much lower. In my world, because I do the overestimation in the beginning, normally, I think maybe once or twice because of different ways taxes are paid upstate, everybody always comes in lower. So as long as I know that you have enough money in the very beginning to cover what my estimated closing costs and down payment is, you should be fine. It's when it goes the opposite way when everybody gets in trouble. So there's a couple of things I also want to talk about, just a little off course of fees, but There's things in the beginning of the process that loan officers tell you to do. Don't open credit cards. Don't make big purchases. Don't get that furniture before you close. Don't do things to your credit or your bank account. Don't move money in and out of your bank account because we got to know where it's coming from, right? There's several different places that it can come from, but you don't need to move it around or put it in one account. You could be getting a gift from a relative. You can be getting a bonus from your boss. You could be using retirement or 401k funds. We will tell you exactly what we need to see in order to provide proof of funds. That's what it's called, proof of funds, to cover the closing costs and any down payment that you need. But we don't want you moving money around. If you have like strange like deposits, maybe you have like a side business or something like that and you're throwing that cash in there, those things need to be explained. So just keep in mind that whatever you want to put into your bank account or whatever you need to do, maybe a lease came due during the process of this and you want to trade in and get a new car, contact your loan officer and make sure that the new lease payment is going to stay good with your approval, because if it doesn't, that can ruin your whole loan process.
Before you sign papers on that lease.
I always tell everybody, if you're trading in a lease, you call me from that dealership before you sign and drive, right? And the reason is because my job is to protect you throughout the process. For whatever reason, if at the end you can't get the loan because, you bought furniture, or you did a car purchase or something like that, that would be devastating to both you and everybody who worked very hard on the loan. So I just want people to understand that we send out a do's and don'ts in the very beginning because we want you to do what we say to do and don't do what we tell you not to do, because it's very important. You play a very responsible role in your loan approval and your loan closing.
People think, and I get this a lot, and sometimes there's circumstances beyond your control, but you can't use your logic and reasoning
right.
and then say, well, this just made sense.
Mm-hmm.
And again, that's why we're here to protect you. I had a client once that their parent died in the middle of the transaction. The parent didn't have insurance, life insurance, which we can always talk about that on the later
Yes, on
date,
another one.
But the parent didn't have life insurance. This person seemed to be like the only responsible person in the entire family. He took out money from his bank, paid for the funeral, and at the funeral got cash donations from people attending. This was a huge problem when he put that money back in to close the loan. All right, what would be a way, and this is a unique situation.
That was very unique.
But what would be your advice before that person took out that money from his account?
So there's several different ways that I would handle this. One, I would ask if there was a business, right? Because you can put money into a business account and the lenders really can't ask you where it's coming from because that's just normal flow of business, right? Another way is to give it to a relative and do it as a gift. Another way is to document, right? In that unique situation, that's different. Because that can kind of be documentable. Mm-hmm. Get the death certificate, write a letter, provide proof of the checks, those types of things.
Not cash from your relatives in that case, but actually them writing a check.
Right. I mean, cash, listen, these are government loans, right? Mm-hmm. The government does not want to see you moving a lot of cash through your accounts, right? What we're trying to prevent here is what they call money laundering. And you can look it up on Google, but I mean, we're talking about, if it's $2,000, that's one thing. If you're talking about $12,000, $15,000, that's a whole nother ballgame, right? $2,000, maybe we can explain away. But the $10,000, $12,000, $15,000, maybe in some cases, I come from a very large Italian family. When somebody dies, we get like $25,000 from everybody, you know what I mean? Here, help support for the funeral and things like that. So that's a little bit more harder to provide proof of. So ask your loan officer before putting it anywhere. Maybe you want to give it to a relative and say, hey, give this to me as a kind of a gift. Or wire it to my attorney. I mean, am I saying too much? Wire it directly to the attorney for your closing.
To cover you, there's things that you're not discussing that would be discussed, obviously.
Listen, I'm giving away the house. These are insider trading information. That's right. What I always call it.
well, you'd be, it's unique. This video is pretty much to help everyone. There's things you can do. So, for instance, putting money in your account, it's not that it's a problem. Sometimes,
right.
Hey, I have a jug of coins at home. I want to put money in. My recommendation would be open up a new bank account and
do
put
that.
that money there, so it's not generating a question.
So here's the other thing. If you don't need that money for your closing costs and your down payment and you're not using it towards that, you could do one of two things. You could do like Steven said and put it in a separate account, or you can put it into your account and then we would just write a letter stating that we are not using these funds towards the closing, and the bank would call what we call back it out of your totals. So if you had $40,000, you deposited 15, now we have $55,000, but you only need the 40, then that becomes kind of a moot point at that stage, right? So these are really good points, and these are things that happen all the time. We get the oops, right? Oops, I deposited $15,000.
Oops, my brother got arrested.
Right.
I had to provide bail.
I had to provide bail, so I used $15,000 of that, but I'm supposed to get it back on the 3rd, and I'm closing on the 4th. Those are things that you need to talk about. As hard as they may be for you to speak to your loan officer about it, I always tell my clients, we become like the closest of friends. We need to make sure that we are speaking the same language and that we're always on the same page with each other. My goal is to protect you, your money, and your new soon-to-be asset, right? So I want to make sure that we're doing everything right. What happens from the day you get your keys and thereafter, you don't have to tell me anything about. But up to that day, I need to know what's going on so that I can make sure that we're putting you and protecting you in the best situation.
What about happens a lot too, child support payments?
Child support payments, or receive or give?
Well, let's deal with payments.
Okay.
So let's say a person is very responsible, has a great relationship, doesn't have a child support order, not with the other individual, and makes steady payments.
So, court-ordered child support is really the only ones that we can use. So I would have to have court order. We have to see it either being direct deposited, or if your ex-spouse or father of the baby.
I was saying individual. I was trying to be all politically correct here.
I was trying to.
Okay.
All right, let me start with who's paying the child support. So mostly it's the men, unfortunately, but so you have to document that. So if it's not court ordered and he's paying you $500 this week and $200 the next week, it's all over the place. We really can't use that money. So just keep that in mind. If it is court ordered, then we can kind of see that going into your bank account, whether it's weekly or biweekly or monthly or whatever it is. And then we have the court order to back it up. Because you also have to remember that kids age out of child support. So in the state of New York, the good thing about New York is that it's not when they're 18, it's when they get through college. So, I mean, you could be talking about the 21. There has to be a continuation of child support for us to use it as income towards the loan. So me as a receiver of the child support from my ex, my kid is 18 and you go, oh, you can't use it. No, you can if I live in New York, because it carries through to the end of college. So he has to pay that through college. So it has to continue for 3 years in order to be using it. So it depends on the age of the child. If the child is 20 years old, he's going to age out before the loan is going to, be completed. So we cannot use it then. If the child is 18 and going to carry to 21, you can use it. So documenting. And I understand that people are friendly and we have an agreement between the two of us, and you're going to pay me $1,000 a week, let's say. But if it's not court ordered, I can't use it unless we can really see that it's child support, and that's harder to document than something through the courts.
Now, what if it is steady payment? It doesn't, like you had given example, 5 here, 2 here. What if it's a steady payment? How long, and again, I know it's not guaranteed because it's the underwriter that's going to make the choice. How long would you say that payment has to be made for the bank to say, okay, that is child support?
That's a really good question. And I'm going to say 6 months to a year of steady payments and make sure they're on the same day so that we can say, see? And then maybe if you have that good of a relationship with your ex, he can supply the proof that that's what it is from his bank account. Then that's something that's explainable, right? Everything's a paper trail. So there's so many things that go into this, and everybody's always like, oh, the process is so long, or, but there's so many moving parts in taking out a mortgage, and it's really our job to educate you and make sure that you know what you're getting yourselves into, because it's not like just a small purchase. Most of the homes in New York are $500,000 or more. And so you want to know what you're doing, and you want to be working with someone that's going to educate you. And I think Stephen and I do a really good job of educating people. It seems like that's what our job is. And I don't mind it, because I really think that if you know what you're getting yourself into, then there should be no question by the time you get to the table.
I actually had a unique experience, and so I had a client once that had a child, was divorced, no child support order. Every month he took out cash on a specific day, and the bank didn't want to fund the loan because they said that had to be child support. What would be your advice in that case?
So again, it really is the amount, right? I mean, if he's taking out $200 at the same time every week, like writing a letter of explanation, can we show the child support in a different way and then show that wasn't child support? Is that something that would be a question that I would ask? So you take this amount of money out every week on the same day for yourself. My underwriter thinks it's child support. If it's not child support, where is your child support? Like, do you have any children? And if he doesn't, listen, we write a letter of explanation, because who are we to call anybody a liar, right? If that's what he's explaining and that's what he's saying, then that's what it is. I can only question you so far. I'm not the government. I'm a mortgage loan officer, and if that's really what it is, we'll write the letter and submit it back to the underwriter. A lot of people think like, oh, the banks are so tough. They want all this paperwork, but we only want to tell the story, and the only way that we can tell the legitimate story is by the paperwork. The paperwork is kind of what I call like the Bible of the loan, right? It kind of dictates exactly what's going on and gives the underwriter no questions. It's why I like to do a lot of due diligence up front. We do a lot of talking up front before you even find a house. I try to gather as much information. If I'm seeing it, the underwriter's going to see it, right? Sometimes child support just shows up on your credit report because maybe back in 2007, you were delinquent on your child support, so it shows up. So I'm going to ask about that. How old is your child? Do you still pay child support? Oh, no, my kid's 28, so I don't have to pay anymore. Okay, great. Can I have a copy of the birth certificate? Because if that's a question to me, it's going to be a question to the underwriter. So I would get that up front, stick it in there, and put a little note on there saying, child's 28 years old, no more child support.
So moral of the story is, confide in you instead of cry to you later.
Correct. I love that saying. I'm stealing that. I'm stealing that. But yeah, I think that it's unfortunate because a lot of people don't, I mean, it's not like we've been friends for 10 years. It's hard for them to kind of like tell me everything that's going on.
It's embarrassing.
But, of course it's embarrassing, but you have to understand, I'm human too. I'm 51 years old. I've been doing this 31 years. There's not a story out there that I have not heard. So every once in a while, somebody shocks me, but we work around it. The reason that I ask you that you tell me everything is so that I know exactly how to put your loan together for the best options for you. And that includes the fees and the down payment. You know, some people have a lot of money to throw at a loan, but that doesn't mean that we want to wipe out their bank account just to put them in a house, right? My goal is to find the option, find the program, find the rate, and find the fees that work best for your family situation. And the only way for me to do that is to know exactly what that situation is.
Well, I've learned a lot. I'm pretty sure everyone else has. Is there anything you want to add to this video before we close?
Call me. No, I'm just kidding.
All right, well, wait. There'll be a link for you to contact Susan. She's great at what she does. We've been working together a very long time. Thank you, folks. I appreciate your time. Hopefully, you learned something. If you have more questions, because I'm pretty sure you might have a unique situation, or some things may have generated more curiosity. You can see she's easy to speak to. Give her a call. Learn more about the process. Thanks so much.
Thanks, guys.
Bye. Hope you're enjoying the videos that you've watched today. They're not meant to be a substitution for speaking with your legal professional, but just an educational tool.
Thank you.